For years, investing in UK property was seen as a safe and solid strategy, a time-tested path to building wealth. But in today's world, with changing market dynamics and global uncertainty, things aren't as straightforward. In this video, we'll explore the key risks in UK real estate investment, how to assess them, and most importantly, how to protect your assets and your returns. Property investment comes with the promise of long-term gains, but also with its fair share of risks. Let's break down the most common ones. First, market risk. Property values can fluctuate due to interest rate changes, economic shifts, and buyer demand. A downturn in the housing market can quickly reduce your asset value. Then there's liquidity risk. Real estate isn't easy to sell overnight. If you need access to cash, you might be stuck or forced to sell at a loss. Management risk is next, especially for landlords. Late rent payments, property damage, or difficult tenants can hurt your returns. Don't forget maintenance and repair costs. From leaky roofs to broken boilers, unexpected repairs can eat into your profits. Interest rate risk is another major factor. As borrowing costs rise, fewer buyers can afford mortgages, which can lead to falling demand and lower property values. You'll also need to navigate legal and regulatory risk. From changing landlord laws to tax rules, compliance is key to avoiding fines and protecting your rights. And finally, natural disaster risk. Flooding, storms, and other environmental hazards are increasingly affecting the UK property market. Now that we understand the risks, how do we assess them? It starts with research. Study the local market, neighbourhood trends, and the property's condition. Run the numbers, calculate cash flow, return on investment, and potential risks if things don't go as planned. Evaluate your tenant risk. Screen thoroughly to avoid costly problems later. Check the legal landscape. Regional rules vary, and staying compliant protects your investment. And when in doubt, speak to professionals. Surveyors, agents, and advisors can help you make informed, low-risk decisions. So, how can you manage these risks effectively? The first step is diversification. Spread your investments across different areas or property types to minimize exposure to any single market. Next, use conservative financing. Avoid over-leveraging. Fixed-rate loans can protect you from rising interest rates. Consider hiring a property management company to reduce tenant-related headaches and ensure professional maintenance. Always set aside contingency funds, because in real estate, surprises are inevitable. Get the right insurance, including buildings, contents, and rent protection where possible. And stay up to date on changing laws. Being proactive, not reactive, is what separates smart investors from the rest. The UK property market is no longer just influenced by local factors. Global events now play a huge role. Take Brexit. It reshaped investor confidence and led to regulatory changes. Or COVID-19, which shifted demand away from city flats to suburban homes with more space. Climate change is also shaping buyer behaviour, with more scrutiny on flood zones and energy efficiency. And of course, global financial movements affect UK interest rates and currency value, all of which ripple through the housing market. For more experienced investors, advanced risk management offers another level of protection. Start with financial modelling. Use tools like sensitivity analysis or Monte Carlo simulations to stress test your strategy. Look at asset class diversification. Residential, commercial, and industrial properties all react differently to economic cycles. Invest in high-demand areas to reduce the risk of long vacancies. Always vet your tenants thoroughly. A bad tenant can cost you months in income and legal fees. And most importantly, build a team. A reliable solicitor, broker, accountant, and property manager will help you protect and grow your investments long-term. In a market where the housing crisis continues to drive demand, the UK still presents solid property investment opportunities. But every opportunity comes with its own risk. The key is finding the right balance between risk and return. A well-diversified, well-managed portfolio, backed by smart research, strong finances, and legal protection, is your best defense. Whether you're investing in residential buy-to-let, commercial spaces, or development projects, take your time, assess every angle, and plan for the unexpected. Remember, wealth is built not just through growth, but through protection. Thanks for watching. If you found this video helpful, make sure to like, subscribe, and check out our other guides on UK property investment. Stay informed, stay prepared, and invest with confidence. Lesson 3 and 4 script. In today's competitive property and investment landscape, managing your assets isn't just a good idea, it's a necessity. Whether you're overseeing a small portfolio or a multi-million-pound estate, asset management is the key to maintaining value, staying compliant, and ensuring long-term profitability. In this video, we'll break down the best practices in UK asset management, explore modern strategies for preserving and enhancing value, and share practical tools you can start using today. So, where do we start? It all begins with a comprehensive asset inventory. That means keeping an up-to-date record of every asset you own. Location, condition, performance, and maintenance history. This database becomes your foundation for everything from maintenance scheduling to strategic planning. Then there's preventive maintenance. One of the most cost-effective ways to avoid expensive repairs or failures down the line. Schedule regular inspections and upkeep based on how critical or heavily used each asset is. And don't forget life cycle management. It's not just about maintaining your assets, it's about understanding their full journey from acquisition to disposal and making smart choices at every stage. Asset ownership carries risk, and proactive risk management is a must. That includes assessing financial, operational, and legal risks, having contingency plans, and staying compliant with all health, safety, and environmental regulations. But today, risk management goes beyond guesswork. It's powered by data. With tools like asset management software, AI, and analytics, you can spot patterns, predict issues before they happen, and make informed, cost-saving decisions. The goal is simple: smarter, more strategic asset control. As we head into 2024, proactive maintenance is no longer a luxury, it's a necessity. Combine preventive and predictive maintenance strategies. That means scheduling upkeep regularly and using real-time data to predict when assets are likely to fail. Technology plays a huge role here. Tools like computerized maintenance management systems, CMMS, IoT sensors, and RFID tagging help automate maintenance, monitor performance, and provide live updates on asset health. This level of control helps extend asset life, lower downtime, and reduce surprise costs. Let's zoom out and talk strategy. The most successful organizations don't just manage assets day to day. They align their asset strategy with their long-term business goals. That means developing a strategic plan that forecasts future needs, adapts to regulatory shifts, and leverages technology as it evolves. Part of that strategy includes lifecycle cost optimization, reducing the total cost of ownership through smarter procurement, timely upgrades, and knowing when to repair versus replace. Then there's preventive. Modern asset management also means managing responsibly. That includes considering the environmental impact of your assets across their entire life cycle. From energy efficiency to ethical sourcing and disposal, sustainable practices are becoming essential, not just for compliance, but for brand reputation and long-term savings. And let's not forget the importance of transparency. Regular, honest reporting to internal and external stakeholders keeps everyone aligned and accountable. Beyond management lies the goal of wealth preservation, protecting and increasing the value of your assets over time. One tool is the Asset Protection Trust, a legal structure that shields your assets from creditors, lawsuits, or disputes. There's also the Family Asset Protection Trust, perfect for long-term planning and safeguarding generational wealth. Business owners might consider forming an LLC to keep personal and business finances legally separate. And for larger estates, family limited partnerships combine protection with tax efficiency, a powerful combo for high net worth families. Staying compliant isn't just about avoiding fines, it's about building trust. Missouri regular cost-benefit analysis, risk assessment, and resource optimization ensure that your assets are delivering real value without draining resources. It's also important to build resilience into your operations. Think of it as insurance against the unexpected, whether it's economic shocks, climate events, or market volatility. By future-proofing your assets, you safeguard your income and your peace of mind. Asset management in the UK is evolving, and staying ahead means being strategic, data-driven, and proactive. Whether you're protecting a family estate or managing commercial portfolios, these best practices will help you reduce risk, control costs, and maximize long-term value. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and explore our other guides on real estate investment and asset protection in the UK.